All right, let's dive right into this explainer and break down the massive ripple effect triggered by the Federal Reserve's sudden policy flip. This shift is literally reshaping everything, from giant stock valuations all the way down to your own wallet. If you've been watching the markets lately, you know things feel incredibly volatile, right? We're seeing a complete financial reversal unfold, and the decisions being made at the highest levels right now are absolutely going to determine who quietly gets ahead and who gets left behind.
So, to figure out why your investments might be acting so wildly right now, we've got a roadmap. We're going to cover 1, the inflation shock, 2, are we in a bubble, 3, the housing market paradox, 4, Bitcoin's strategy problem, and 5, your survival guide. Let's get right into it.
Starting off with Section 1, the inflation shock, the catalyst for the Fed's flip. We absolutely have to start with the one macroeconomic force threatening the value of nearly everything in 2026, which has completely forced the new Federal Reserve Chair, Kevin Warsh, to alter his entire economic outlook. Now wrap your head around this staggering 4.2% figure. That is the CPI, the Consumer Price Index, which measures the cost of our everyday goods. Even though we saw rising prices trending downwards over recent months, inflation has roared right back to a 3-year high. And when you dig into the numbers, almost all of this inflation comes down to one single source: energy. Because of the ongoing conflicts in the Middle East, energy costs have nearly doubled in just the last 6 months. That's huge. And this brilliantly illustrates why the Fed is totally backed into a corner right now. We have to look at the PPI, which basically acts like an early warning system for consumer prices. It's inflation coming down the pipeline. The recent PPI numbers came in way worse than expected. So what does that actually mean for us? It means if a tentative peace deal with Iran falls through and oil spikes again, the Fed won't just pause. No way. They'll be forced to actually raise interest rates to stop prices from skyrocketing, which completely cancels the rate cuts the market was hoping for. Moving right along to Section 2. Are we in a bubble? Tech IPOs and equities. As these inflation fears ripple outward, they collide head-on with an incredibly eventful stock market, one characterized by skyrocketing AI activity and history's largest IPO, SpaceX, sitting at a massive $2 trillion valuation. So the crucial takeaway here is that while buying into the incredible hype feels super rewarding, the actual data tells a completely different story. If you look at every tech IPO over $1 billion since 2010, the average return of 248% looks amazing, right? But wait, that average is heavily skewed by a tiny handful of lottery ticket winners like Shopify. When you look at the sobering median tech IPO, it's actually down 7.4% 6 months after its first trading day. The reality is, expecting a 30x return on a massive, already matured $2 trillion company like SpaceX is extremely unlikely, especially as existing insiders predictably begin to offload their shares. To put this into a really clear perspective, let's compare today to past market cycles, because the analogies are terrifyingly clear. The S&P 500's price-to-earnings ratio, which is basically how much investors are willing to pay for one single dollar of a company's profit, is hovering near 40. The only other time in history we hit this extreme was the peak of the dot-com bubble back in the year 2000. According to Bank of America, the market is currently overvalued on 17 out of 20 traditional metrics. And get this, 8 of those metrics actually exceed the extremes we saw right before the dot-com crash. However, to remain completely impartial here, we really have to look at the danger of panicking. Just because history rhymes doesn't mean you should immediately jump ship. The exact same Bank of America checklist hit a 70% warning level back in February of 2025. If you had panic sold your portfolio based purely on those pessimistic metrics, you would have completely missed out on a massive 20% rally that followed. It's literally a prime example of why timing the market is so incredibly dangerous. All right, let's look at Section 3, the housing market paradox, gridlock in real estate. Let's step away from equities for a second and see how these elevated interest rates are causing a totally fascinating ripple effect in the housing market, where the post-pandemic recovery is basically hitting pause. Typical homes are up just 0.8% year over year. As you can see, the real estate market right now is intensely location dependent. It's like a tale of two different countries. We're seeing a major geographic split. Prices are actively falling in previously booming areas like Austin, Denver, and large chunks of California. But meanwhile, prices are actually rising in places like Rockford, Illinois, and Syracuse, New York. Why? Well, younger buyers are simply abandoning those crazy expensive coastal cities for more realistic price points in the Midwest. Now, here's where it gets super weird. This is the core paradox of today's housing volatility. Traditionally, when interest rates shoot up, home prices should naturally fall because mortgages become way too expensive, right? But that is just not happening everywhere. Instead, sellers who realize they aren't going to get those wild, record-high 2021 prices are simply pulling their homes off the market entirely. This creates severe gridlock. It artificially chokes the supply of available homes, which paradoxically keeps the prices of the remaining homes stubbornly high despite those crushing mortgage rates.
So looking at the key risk factors for individual investors, it's basically a massive game of chicken. You need to know who actually has the leverage here. Buyers, you finally have the leverage to walk away. Don't be afraid to submit aggressive offers below asking, and absolutely shop around to shave every fraction of a percent off your loan rate. Sellers, on the other hand, your playbook is the exact opposite. You've got to abandon that fantasy of 2021. You have to price aggressively up front, because the longer your house sits on the market, the more leverage you lose, and buyers will definitely start assuming something is wrong with the property.
Which brings us to Section 4, Bitcoin's strategy problem, the digital asset sell-off. This exact same loss of leverage we just talked about is being felt far more brutally in digital assets, where Bitcoin has fallen roughly 40% over the last year from its $124,000 all-time high.
Now, while a lot of broader money is distracted right now chasing AI and tech IPOs, sheer market panic actually ignited in the crypto space over a remarkably tiny number, 32. So, Michael Saylor's company, MicroStrategy, is the largest corporate holder of Bitcoin, owning over 4% of the global supply. They famously built their whole reputation on never selling. Yet, when it was disclosed that they sold just 32 Bitcoin out of their massive stockpile of 844,000, the entire market essentially panicked.
And this perfectly illustrates a major structural risk factor when it comes to centralized corporate hoarding. Think of it like a domino effect, or really a financial death spiral. MicroStrategy buys Bitcoin by issuing shares, enticing investors with a massive 12% dividend yield. If Bitcoin's price goes up, great, they cover it. But if Bitcoin's value falls, they face a total crisis. They either have to heavily dilute their current shareholders to raise cash, or they're forced to sell their Bitcoin to pay the overhead. And if they sell, the market drops further, causing them to sell even more Bitcoin. It's a structural loop that has investors deeply spooked for sure.
Despite all this structural anxiety and the recent choppy performance, institutional analysts are fiercely divided on what actually happens next. Standard Chartered believes the bleeding is over and the bottom is officially locked in at $59,000. Conversely, Galaxy Research sees the potential near-term drop all the way down to the $40,000 range, though they do maintain a massive long-term price target of $250,000 by 2027. It just perfectly highlights the intense uncertainty in this asset class right now. Finally, let's hit Section 5, your survival guide, preparing for the unknown. Let's pull back out to the macro level and examine what the Federal Reserve's summary of economic projections and the new Fed leadership under Kevin Warsh ultimately means for your personal survival strategy. The market is actively panicking because of two massive shifts. First, the Fed is signaling actual rate hikes in 2026 before we see any relief, with inflation expected to stubbornly sit around 3.6%. But more importantly, Chairman Warsh is actively trying to remove what's called the dot plot. The dot plot is how the Fed traditionally gives the public transparency on future interest rate moves. By eliminating it entirely, the Fed is essentially saying they want to signal less and do more, meaning everyday investors would be flying completely blind, entirely in the dark regarding future economic guidance.
So what do we actually do? Well, in a world full of unpredictable oil shocks and sudden crypto crashes, nobody can perfectly time the market. I love this quote from one of our sources, a self-described random dude making videos in a half-converted garage. He put it best: the most reliable strategy remains beautifully simple. Strip out the emotion, ignore the noise of the daily hype cycle, and consistently dollar-cost average into the market. Buying in consistently over time is historically the absolute strongest defense against this kind of macro-level chaos. We've covered a lot today. We've seen exactly how macroeconomic inflation shocks ripple all the way down into everything, from the massive SpaceX IPO to the strange gridlock in your local housing market, and even the structural fears hiding inside Bitcoin. You can't control the Federal Reserve, but you can control your strategy. So, taking a hard look at your own investments right now, are you positioned well enough to survive whichever direction the dominoes fall next? Think about it. Thanks for joining me on this explainer, and I'll catch you in the next one.